are officially live on Facebook for the Thursday edition of the Not Your Average Investor Show, when we do the JWB Property of the Week. I'm your host, Pablo Gonzalez. With me, as always, the man that a very bright person one time called GC because of his genius cash flows, because he generates, because he's genius.
Come on, man.
I'm just totally choking over here with the inventor of it. Because he generates cash flows, because he's got genius concepts, because he's a great co-host. And another person invented the name Gregg Cohen. Say hello, Greg.
Way to land that one, buddy. Smooth, clear as mud there, bud. Great to be with you all.
Great to have you, buddy. Our super de-duper community manager is in the house, Madison the Magnificent. Say hello, Madison.
Hello, everybody.
And our guest investor today, the man that I like to call the most interesting investor in the world. He is a former Rookie of the Year in the California Horse Racing League. He is a Best in Show recipient or equivalent, whatever you call that, in alpaca farming and displaying. He is a man of many talents, including college volleyball player, ex and pro surfer, and a investor across every asset class that you could possibly imagine. He gave GC the genius concepts that generate cash flow, the great co-host, name that we have not stopped repeating since his first appearance. He is Zach Correa. Aloha, Zach. Welcome to the show.
Aloha, hooey ho. How's it, GC and PG? Great to be on the show. Thank you for having me back.
I feel like we're talking to the Godfather here, don't you?
I am.
This is amazing.
I get a little starstruck. I get a little bit starstruck, and I love being here with the community today. They are in the house. If you're listening to us on the podcast like Zach likes to do, you're in good company because Zach does it. But the best thing you can do is do what Zach did right now and join us live one of these days. Go to nyais.com, sign up, throw it on your calendar, show up here whenever you got a little bit of time, and be part of the roll call. You ready for the roll call, Zach?
Sure, let's roll it.
Roll it. Let's go. We got Madison already welcoming everybody in the chat. We got John Henning. John Henning, you're being notorious for being the first one. Good afternoon, all. Drew Barnhill, the ringmaster of the Not Your Average Investor Show community. We got Jen Filson, the fairy godmother of the Not Your Average Investor Show community. We got Leo Faraganan.
Dun, 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 dun.
Faraganan.
Dun, 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 dun.
He says good morning and all. It's going to be another rocking show. He's a hairband rocker.
I trust that.
We got Ken and Carolyn Moline, the matriarch and patriarch of the first family of the Not Your Average Investor Show. We salute you.
Tip of the cap.
We tip of the cap. We got, who else we got? We got Noah Rundari. Noah's back.
Noah's coming. Noah's coming next week.
Noah's coming. We're going to get to Noah him.
Oh man, I can't wait. Can we finally get a nickname for Noah? Noah, we can't leave next Friday when you're here for the Not Your Average Investor Show meetup and downtown walking tour. We cannot leave without a mutually agreed upon nickname that you love.
I'm going to tell the worst story ever.
Okay.
About 5 hours ago, I was like, I figured out Noah's nickname. And right now, I completely forgot.
Oh, goodness.
So it's on my mind, Noah. We're going to land this plane for you, buddy. We got Hervé Francois. He's talking about the dress shirts. We're a little different today, Hervé. You might not be able to tell, but this is light blue and this is green. So we're not shopping the 2-for-1 sale yet. Yes. But it is coming. It is coming. Who else we got? Hervé's joining us from the Jersey, as we like to say. We got Nadeem Shah, Zach's fellow Seattlean or Washington Station, however you want to call that. We got David Singh. He's back. He's saying, "What's going on, everybody?" David from San Diego, another great place to surf. I'm sure Zach knows that area very well. And we got Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
Home of the manatees. Loving it, man. I love having the community in the house. And I love Thursdays for one reason.
Yeah.
Because Madison shares good news.
You know, that's my favorite part too, honestly. I get so bored on Tuesdays. I have nothing to say except it's for hi, but all right, everybody. I have some pretty cool news. Repeat referral sales for you amazing clients. We have had 3 families put more houses under contract within the last few weeks. A little shout out to the returning Rosalind Riley.
Woohoo!
And her husband, Gary Riley. They put their 4th property under contract.
Wonderful.
Roger, we all know Roger. We love Roger. He put his 9th property under contract.
Heyo.
He's almost at those double digits. So super cool. And then Vivian Burke and her sister put their second property under contract.
All right.
Oh, yeah.
Congratulations.
Super exciting, super cool. So that's a
That's
good news.
amazing. I'll tell
That's
you what,
that's what I call good news.
it's a good deal.
It's a good news. I like it. All right. And thank you, Madison. We love that segment. And now for the other segment that sometimes graces us, it's a GC's breaking news.
You know, I'm very much into like superhero mode with my son, Cameron. He's 7 years old and he loves the Flash. And there's this alter ego of the Flash called Reverse Flash. It just does everything like terrible. I feel like I'm kind of like the Reverse Flash to Madison being the Flash, because I don't really have great news for the overall economy here, right? We would be remiss if we did not mention what has happened with the Fed lately and what has happened, the reporting of the Consumer Price Index. The Consumer Price Index is important because that's what the government uses to measure inflation. If I take you a few months, well, if I take you 40 years ago, we had the highest inflation ever 40 years ago, and we haven't seen that type of inflation since until the last year. And the Fed has really tried to tamp down inflation. They've taken a number of measures. They haven't been successful. But if you go back like last month when CPI came out, it had actually dropped from 8.5% down to 8.3%. That was actually looked at as potentially a good thing. Now, 8.3% inflation, 8.3% CPI is a bad thing for everybody. And the Fed's not happy with that. But the markets looked at that and said, well, maybe we have this inflation thing kind of moving in the right direction. Maybe. And then the next month, what just happened in the last few days is this Consumer Price Index, a report came out again, 8.6%. 8.3 to 8.6 might just seem like 0.3 of a point. But in terms of economic and investor sentiment, that took the wind out of the sails of the market. Since then, you've seen the S&P 500 go into bear status. The markets have absolutely taken a tumble. And the reason here is because this hope that the Fed could create a soft landing of reining in inflation and not driving us into a recession, it's like that hope has left the building now. And that's why you're seeing the markets, meaning the stock market, react that way. So what this means for all of us is that, you know, geez, about a month and a half ago, we talked about how the market signals of the stock market were leading towards some pain. And this pain was probably going to be prolonged if you looked at other bear markets. What we're seeing now is that pain is starting to be realized. And the unfortunate thing for all of us as an economy is that it's probably here to stay. It's probably going to be prolonged. When you're looking at the market signals for the stock market, they're not looking good. They didn't look good a while ago, and they don't look good right now. But investor sentiment is at a low. And largely that's how the stock market is driven. So this has never been a better time to invest looking at market signals. You've got market signals in the stock market that do not look good. You've got market signals for Jacksonville real estate that look good still. And even if you look beyond just Jacksonville real estate, there's never been a better time to invest in hard assets. Like a rental property is a hard asset. There's never been a better time to invest in hard assets with smart debt, especially in populations that are growing. So there is a light at the end of the tunnel. But for overall, as an economy, I think there's a lot of pain to be had. I think there's jobs that are going to be lost. Recession, I think, is happening. And I think, you know, a lot of businesses and people are in for some economic hardship, that's just what we have to deal with.
All right. Well, on the back of that, Zach, I'd like to kick it over to you. When you're listening to this stuff, you're one of the headier guys that I've ever spoken to about investing, and you're in all sorts of different kind of areas. As you are reading these headlines and doing your own analysis, how does this stuff land on you? How is it affecting the way that you think and how you're moving forward?
Yeah, I agree with Greg. I do believe now inflation is becoming influential in financial strategies. And for those who believe in an increasing inflationary environment, hard assets, real estate, and leverage, paying down loan with cheaper future monies is really a great strategy. For me, the pros of that is more hard assets, real estate properties, and I call them engines or thoroughbreds, therefore more income sources, leverage still the rates, so increase equity and appreciation, cash flow positive at currently, and then inflation, it really protection against inflation, preservation of capital. Some of the constraints I see though is to time to pay off, if that even matters for you in your portfolio. The value is in holding smart debt for a long period of time, full market cycle, right? More leverage means more mortgages, but really is not an issue as long as one doesn't get over leveraged. That's how I look at it.
I love it. I mean, those concepts have played well for decades before Zach and myself and Pablo started to invest. They've been playing well for decades before. They play well right now. Those concepts are going to play well for decades beyond this conversation as well. We're not inventing anything new here.
Let me throw a curveball question out there with this like historic rate hike that just happened. Is the debt still smart?
It's a great question. Did I even mention the rate hike?
I don't know. If beep, 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 beep,
Yeah.
beep, beep. Greg's got another breaking news.
Well, so there was a CPI that went up. The Fed in response just bumped their benchmark interest rate 0.75 of a point. That is the highest increase at one time since 1994. This is the Fed throwing everything they can to tamp down inflation. And, you know, the hope for everybody was that they could tamp down inflation and still keep us out of a recession. That is becoming very, very unlikely. The Fed has to choose, and they're going to choose to jack up interest rates or do whatever they possibly can to get inflation down, even at the expense of recession and jobs. So your question is it still smart debt? Smart debt is known as debt that is relatively inexpensive with great terms. It's debt that the asset pays for itself. So in real estate, more rent comes in than the expenses that go out. So it pays for itself. And it's on an asset that goes up in value over time. Real estate goes up in value if you give it a long enough cycle, which is 10 to 20 years. So when you look at the debt that we have now, you can get a loan right now on a single family rental property for about 6%. Now, when we hear that, we think, oh, geez, a year and a half ago, I could have had one for 4%. And we feel like this is a 50% increase to our interest rate, and it doesn't feel good. But we need to think beyond just right now. We need to think about other times. We also need to think about beyond this debt opportunity here and think about in the world, like where else can you get 30-year fixed rates with low interest? Like you can't do that in other countries. Like the US is pretty much the only country where you can do that. You can't get the same financing if you're in Canada or in almost every other country in the world. So there's that to consider. And just think about historically interest rates. This is still very low for historical interest rates. Like in the early 80s, your interest rates were like 18%. You know, like when I started to buy my own rental properties in 2006, my first interest rates for debt on my rental properties were 7.5%. And I was stoked. And it's because it's still smart because it pays for itself every single month. The income of the rent still pays for itself. It's still an asset there. And then of course, long-term, you got to buy and hold to do it. So yes, it is absolutely still smart debt, even though it just doesn't feel as smart as it did a year ago.
Sure. What do you think, Zach? What's your answer to that question?
I agree with Gregg. Investing in real estate, whether it be residential or commercial, allows you to capture the best risk-adjusted returns on investments passively. Not many other investments out there today that produce positive cash flow monthly and allow you to potentially earn 12, 15% IR plus or 20% plus ROI. It's a win-win, right? The deal is in the debt, smart debt, as GC's concept goes with. Three things: focus on the return on investment, best risk adjustment return, diversify your portfolio. You know, you're getting there, Pablo. You know, you're 3+. I look at 3+, right? And then establish consistency with your cash flow. That's how you continue to build a successful portfolio and really gets to your end goals, right? And I think GC hits it on the head. That real estate is the one that provides you with those opportunities.
Love him.
Yeah.
I just love him. I just love him. I mean, I'm just simple.
I do too. I really wanted to come next week. Whatever we can do to make you come to the Super Duper meetup next week, you let me know what it is, Zach. We will make it happen, my friend. All right. So now, speaking of going somewhere, Zach, we kind of teased your investment acumen. I think you have clearly flexed that muscle in front of everybody right now. Let's magically whisk ourselves away right now to the property of the week.
Week.
And we're going to go here to 2281 Kistler Ridge Way. I have not practiced this name clearly. And it is a $270,000 property, a 3-bedroom, 2-bathroom, 2-car garage. Rent rate is estimated at $1,688. And you see a beautiful little picture here. For those of you that are not following in the podcast, it's showing the quintessential blue Jacksonville sky, which it always is out here. And monthly cash flow of $42 and a monthly ROI when conventionally financed of 12.41%. Before we go to our guest investor, GC, what do you love about this property?
I'll tell you what I love about this property, Pablo. This, first of all, let's talk about the fact that this property is available, right?
It's available.
It is available.
It is for sale right now to an investor.
It is available.
Okay.
This beautiful thing that we have tried to create where we would only choose properties like a day in advance or whatnot is working to perfection, because now the vast majority of the ones that I bring you on property of the week are available. So this one is available for purchase. Availability is critical right now on the heels of what we were just talking about, where the Fed is raising interest rates, the most aggressive raise of an interest rate since 1994. I don't know how many years that is. Somebody can do the math. Many, many years. The Fed is raising that interest rate, which has an indirect effect on your long-term mortgage rates. So your long-term mortgage rates are going to go up because of the Fed's actions today. And what that means is if you have the opportunity to buy this property on Kistler's Ridge, that's kind of hard to say.
It's hard. It's harder than it looks.
Kistler's Ridge Way today, if you had that same opportunity to buy the same property 6 months from now or a year from now, it is going to return less to you, even though it's the same property. And it's because your interest rate on your loan is going to go up. And so this is really important. The other thing is that debt doesn't change for 30 years unless you want it to. So you lock it in right now, and that locks in positive cash flow today. And oh, by the way, rents and home prices tend to go up with inflation over time. And so it tends to get better from there. So availability is really important. There is an extreme lack of supply in the market. So a lot of people see this, and that's why so much money is still rushing into rental properties, and they're trying to buy them because they're inflation protected as well, and they just don't have access to it. So when you see an opportunity and it's already done for you, it is like ready to go. That is very rare in the marketplace today. And you want to take advantage of it before interest rates go up and before home prices go up. I just wrote an article for the Jacksonville Business Journal. And the title of it is, are home prices in Jacksonville still going to go up in 2022? And the data is showing that yes. And the data is something that we look at all of the time here. The most important data piece is months of inventory. And that's still showing that home prices are going to go up. And so when you have interest rates going up in the future and you have home prices going up in the future, and you have the ability, especially to buy something that's new construction and to close on it in the next, call it 45 to 60 days, there's a lot of value there.
A lot to love. A lot to love. Zach, when you look at this performer here, what are you looking at? How are you evaluating a deal like this?
It's so funny that I know the last one of the shows, GC, you talked about the fact that your portfolio, your own personal portfolio, has more renos than you do new constructions. I have the same thing, right? We're about 50-50, but man, we fell in love with new constructions for JWB. A lot of the reasons for that is it's new construction, right? It's the eye candy kind of thing, right? But to me, what I look at on this specific property, it will generate an estimated 12% IRR. That's big for me, right? It has low property insurance costs because it's a brand new construction. And finally, you know, we'll create positive cash flow and above average home price appreciation because it's in that type of market. Those are the things that I'll look at. The proof is not so much in the performer as it is the actual data, but I believe that looking at this, it's a win-win for everyone.
Well, I love the fact you just brought up a really good point. I mean, the pro forma is a necessary part of it, but the actual data is something that we get to look at for Zach's portfolio here towards the end. Zach hasn't even seen this yet, so I can't wait to look at the actual data with you, buddy.
Me too. Me too. But yeah, I look at these properties and like I said, I think people get the analysis paralysis, right? Is that they're looking so much into the data, like how much it's going to cost me and so on and so forth. Sometimes if you do your due diligence on all your work, your education, getting the right team as you perform all of this, if you can do all of that and do your due diligence in building a good, solid business plan, the implementation and acquisition and diversification of your portfolio is the easy part in my mind. Selecting these type of properties is every day, twice on Sunday, an easy decision from an investor perspective, because the proof is in the success of the company and the team. That's what I trust in the most.
Well, let's dive into that a second then, Zach. You and GC were kind of bonding before the call about like how happy you are with all this stuff. And GC's like, man, this really means a lot coming from you, because we know that you have a lot of different options, right? Like you had success in horse racing, you had success in alpaca, you had a bunch of capital, you have a high paying job, right? And you're saying right now you value the operator, right? So like when you decide and you're looking at this thing, you're like, yeah, it's a great house in a great market, operator. Right? Like, what was the decision-making process like for somebody looking at an operator, for somebody looking at the way that you see the world? How did you make that first decision?
That's a great question, because I do believe that when we get into investing, people tend to look at beginners, tend to look at the property first, right? For us, it is around the team and operator. I believe the success is that a successful team, a proven record with a successful team and operator that is vertically integrated, it takes precedent over the property. So for us, one of the most important steps was establishing our investment team. And I talked to you about this, Pablo, before the call, about our mentors, our coaches who guided us through the process, including building our portfolio and really trying to limit our risk tolerance and putting together what we figure is our really good plan for real estate investing. When we decided to invest in real estate as passive income investors, our focus was not to look for a specific real estate market. What was important for us was finding a great property management team with an outstanding reputation, successful track record, vertically integrated and specializing in turnkey properties that can produce us things like instant equity, solid IRR, cash on cash returns, located in a strong market and has a real long-term residence in place, providing immediate cash flow and the potential of property appreciation. It's hard to find all of those, right? You really want the team to take precedent over the right property. The right team takes precedent over the right property. And for us, that's how we looked at it. In building up our portfolio, the right real estate turnkey team, which offers us full service property management for stress-free investing, is the way to go. Fully vertically integrated is how we look at it.
I mean, how did you decide that, spoiler alert, you invested with JWB. How did you decide that JWB had that team versus other offers that were on the table?
Our coaches and mentors. So as you guys know, our story is back in March of 2019. I was listening in a car on a radio, and they had an advertisement for fortune builders. And we went to one of their seminars and we got into it, right? It was our next venture, right? Horses, alpacas, real estate, right?
As the good Lord intended it, right?
And we had a passive income coach that said, hey, you know what? We have a great relationship with a company. So you got success that breeds success, right? We have one important person that's providing us, and it allows us to bypass all the rhetoric and red tape about trying to figure out who are those successful entrepreneurs and successful companies out there that have vertically integrated programs that we can just hang on their coattails. Pablo, you're doing the same thing right now with JWB. Three properties in 16 months. I mean, awesome. That's what we did, right? But I don't have to be the expert in the room, right? You guys heard my term, case, copy and steal everything, right? And so I've learned from the best. I've done my due diligence. I've confirmed that, that these companies, property management companies, are hard to find. We have interviewed others that failed on us, that we didn't hire, just because it didn't have the same success proven record as JWB. And that's how we got involved with JWB. It was easy walking in the door, seeing how the business model was portrayed, the customer service, just the integration of the dynamics of the team was an easy decision for us to become equity partners, so to speak, with JWB.
There's just what I love about Zach's message is there's such a humility in his approach, right? Like it takes a really humble person to seek out a mentor and then to listen to that mentor. And, and then it's another thing of just taking action is a hard thing for people. But Zach's success is because of his relationships, right? His ability to learn from people that are just in one part of life or investing or whatnot, just in one part, they're at an elevated place than he was. And he loves that fact. And he's like, let me go seek that out. And then let me ride their coattails. Like, let me copy and steal everything. Like, there's nothing wrong with that. That's what I did in 2006 with Fortune Builders. Like, there wasn't a Fortune Builders at that time. It was just a company that was successful. And I did the same thing. And I'm like, hey guys, I really like where you are. I'm not there as far as investing. I want to have what you have. Is it cool if I just like hang around, pay you some money, but like hang around and copy and steal everything? And they're like, yeah, that's our business model. Go for it. Right. But it takes a really humble person, I think a lack of ego to be able to seek those opportunities out. I think it's what prevents a lot of investors from being successful.
Yeah, leveraging other people's success systems and expertise to accelerate your success. There's no apologies for that, right? Because it accelerates your learning curve. The more you learn, the more you earn, right? You stop learning, you stop earning, right? And so I rather learn from other successful investors' mistakes so that I don't make them myself, right? I don't want to replicate mistakes. I want to replicate success. And that's what we do. That's part of our business plan.
So good, man. So good. I love it. Coming from you who has done so much. And again, the humility is amazing. For me personally, this is what we've tried to replicate here, right? Like this idea of access to people like Zach, access to people like Drew in the chat or Lee or Ken, or, people that have had these success cases, and create this community so that you can find it through Fortune Builders. You can find it by showing up here, right? Like the idea that getting two people talking about you when you're not in the room and letting somebody else listen is the best kind of like source of really understanding if you are real or not. So I love hearing stories like this. And because of that, I want to lean into the Q&A right now from our chat and from our community that's in the house. I'm going to start by popping this back up on the screen. Drew Barnhill is the ringmaster of the Natural Average Investor community. He asks, is that $487 annual insurance cost accurate? That seems really low.
Yeah, that is really low. And that is accurate. And, new construction, one of the ways that we're able to provide positive cash flow in new construction properties is because of low property insurance costs. And that's, because new construction properties, generally speaking, are higher cost than renovated properties. And so if we're ultimately going to get back to the same, call it 11 to 13% estimated returns on investment, well, one thing that new construction is really going to look good at is low insurance costs. One of the things renovations is going to look good at is it's going to be a lower purchase price. So you get there through different ways, but you end up at the same place. So new construction property insurance costs are lower than renovated home insurance costs. And that's because of the way the insurance company assign risk. Homes that were built a long time ago tend to break down more. And, homes that are just built, brand new construction, tend to break down less. And so insurance premiums are lower for new construction homes.
There you go. True story. Believe the hype. All right. Jen Filson's got a great question here in the Q&A that I want to open up to the two of y'all here. She says, I have $50K in cash right now to invest. Should I, 1, buy another JWB property, 2, pay off one of my JWB mortgages, or 3, put it into private lending? Zach, we're going to start with you, man. What do you think is the answer there?
I think there's 3 things that you should consider, Jen, is time, timing, and capital, right? What I mean by that is that when you make decisions like this, you should, first of all, is time, right? Is how much time do you have to wait for this to build, the capital to build that you're going to be, whatever you invest in, whether it be PML, whether it be commercial, whether it be rental real estate, whatever you decide, do you have the time to have it in there? We talk about the full market cycle, right? And timing, right? The second thing is timing. So where in your life are you relative to your overall strategy, right? Are you in a retirement stage? Are you in, in the middle of building your portfolio. That depends as well. And then the final thing, obviously, you said 50,000, but your capital, right? The amount of capital you have will dictate the type of investment you're going to do. So whenever I make a decision, I look at those things: time, timing, and capital.
I love it. I think this goes back to the goals, very similar to what you're saying, Zach. Let's just kind of lay out. Zach said PML, so private money lending is what he's talking about there. Let's talk about the three options here and what are the best return opportunities, and then what are some of the stuff that you have to deal with in order to get that elevated rate of return. So buying a rental income property for a full market cycle is going to deliver the best return on investment. It's going to deliver a better return on investment than private money lending as well. And it is going to give her a better return on investment than you just simply paying back a loan. Right. So you can see here on the evaluation that this property is expected to earn about 12.5% on your money each and every year. And you can compare that to private money lending, which, you know, when you talk about the velocity of money, it's a 10% interest rate that you would earn, but then there's some downtime with it. So call it about 9.5%. So you're able to earn 3% per year more with significant upside to do more than that on owning rental properties. And so that's why owning rental properties is a better return on investment over the long haul than private lending. Now, for owning rental properties, you have to be in for a full market cycle, right? If you're not in for a full market cycle, that's not as clear there. Private money lending wins when you have somebody who's very short term, right? If they want to get their money back in 3 years or something less than that, right? Private money lending tends to win because that access to capital and to be able to turn that over is more important. The other thing is like, and we can talk about this in Zach's portfolio, because I always love to talk about the good, the bad, the ugly, but you have to be able to withstand the fact that there are going to be bad things that happen to your rental property portfolio. You don't really have to worry about that nearly as much when it comes to private money lending, because if there's a maintenance issue or an overage on construction or whatever, that's not coming back to you. That's a JWB cost when it's private money lending. When you own the asset and you have the ability to take advantage of the upside of the asset, you also are on the hook when something bad happens to your rental property as well. And JWB does a great job. Our whole mission is to try to make this a wonderful experience, but we're not perfect. And you have to have the stomach for the fact that every once in a while, you're going to get a call and we're going to say, listen, a resident did something here, or somebody moved out early, or God forbid, there's an eviction. Like, I want you to know that before you go in. So higher return opportunity for rental properties, slightly elevated, you know, things that are going to go wrong compared to private money lending. Private money lending is set it and forget it. As long as you believe in the operator can perform, you don't have to worry about maintenance and vacancy costs. You're going to earn, call it, it's a 10% interest rate, a little bit less than that when you think about the downtime of the money. Paying the debt down, if you have an interest rate of, let's say, 5% on your mortgage, and you decide to pay that debt down, that still might be the right thing for you based on your goals. But just think about the return that you're earning on your money. You're earning 5% there. When you pay down a 5% loan, you're earning 5% on that money. So that would be the lowest return opportunity there, and really would be important if just max cash flow is of most importance for you to do that. So Jen, take that, you know, talk to Jen. We talk all the time. So let's talk to the team or whatnot, and just kind of come in with that mentality of where do you fit in that bucket, and let that guide you as to what the right move is for you.
Yeah, I think one comment I would make on that is that I think one lesson learned for a lot of investors, at least new to it, is that it's always exciting, right, to buy a new property and get invested, and you can see the money coming in and so on and so forth. But the one caution for everyone in investing in my world is not over leveraging and being able to make sure you have enough reserves for those instances that will happen. Not if they happen, that will happen, right? And I think a lot of investors, they forget about the fact that I need to have these set side of reserves and not over leverage themselves to accommodate those instances where it will happen and will occur. And I'm sure you're going to see it in my portfolio as well, that things happen, and it's not perfect. It's not a perfect world.
I love the frameworks that you always bring, Zach, right? Like case is something that I have never forgotten. Time, timing, and capital. I'm definitely going to go back to the woodshed on explaining this type of stuff, right? Because it works so neatly as you compare the three different scenarios, right? Like the idea of private lending. Well, this depends on where you are at in your stage in life, the timing of when you need the money back, and the same as for rental property investing. And then the capital piece, of course, what do you put it in? How much do you have available to you for reserves, for what you need immediately, right? Like, do you need the cash flow on a day-to-day basis versus later on in life? Like, really, really great framework of timing, and capital. I love that. So we're totally going to make a clip out of that one. All right. So we got Ken Moline, patriarch of the Not Your Average Investor Show, First Family. If you are considering accelerated loan paydown, would you choose to pay down the asset with the lowest loan balance or the asset with the highest loan interest rate? Zach, let's start with you.
Lowest, C3X, right? It's the lowest. You always focus on the lowest. So as you continue to have the full market cycle, you take all your cash flow. If you don't need it for your regular, fixed income, it's always recycled back to the first property that has the lowest debt available for it. So the lowest mortgage is how you do it.
I love that. I love it. He's exactly right. And the reason that you do that is because you're trying to get one mortgage off quickly. Because when you get one mortgage off, let's say that the mortgage payment happens to be, let's just say $1,000 a month. Well, you just now increase your cash flow by $1,000 a month, right? So the other alternative is if you just took the highest interest rate, right? Yeah, that makes sense because the cost of that money is higher and you get slightly higher savings by doing that. But that doesn't drop the loan balance as quick, right? The goal here is how can I erase one of my mortgages? Because that's when this model we call C3X or the waterfall method, that's when this really gets fun. You go from maybe putting $100 or $200 towards the payoff of one property now to $1,200 towards the payoff of your next property. Watch how fast that gets paid off, the next lowest loan balance. And then maybe you just freed up $1,000 there and I don't know, 8 years, I'm coming up with this. But then now you got $2,200 towards your next property and that gets paid off in 5 years. And then so on and so forth. So the goal here is how do I free up these huge chunks of cash flow rather than paying down the highest interest rate mortgage? Yeah,
that's a great point, GC. I mean, our goal is time to desired cash flow, right? Time to desired cash flow. That's really the important, that's the most important goal for us to focus on right now, given where we are. And I think from a time perspective question, I think of it as two options. A, look in the end time, or create option and alternatives that can be applied in the future to achieve your end time, right? And that's what this waterfall, the C3X will do, is if you can focus on what your time to desired cash flow is, you'll be able to figure out how that system works to your benefit as well as to get to your goal of the end time.
And I'll just add, it's such a cool concept, but it's hard to understand through a podcast or through Zach and I just talking about it. We have this calculation. We do this as a part of our onboarding process for all new clients and current clients. And so if you're wondering how this can apply to you, how you could take a 30-year mortgage and just take positive cash flow and maybe pay that thing off in 17 years or whatever, the numbers work out to. Like, I think it will blow your mind. And that's something we offer. So reach out to our team, go to chatwithjwb.com, get on the phone, take a look here. It's really foundational to why rental property makes so much sense.
Awesome. Let's try to knock out a quick couple more questions, and then we're going to get into Zach's investing journey, which I know GC put a little extra elbow grease into this time around. All right. So David Singy's got a question for Zach. What is your approach to discover if you are over leveraged or not? If my goal is to acquire 3 properties with JWB as fast as possible, that would have to be through conventional financing. How do I figure out if I'm over leveraged with that approach?
So for us, I think that the real question you have to ask yourself when I look at things is there's 2 questions I think every investor should ask themselves. And one question is, do I want to create passive income or do I want to become a full-time investor, right? Is the question you need to ask yourself. Because if you're a passive income from a passive income perspective, you should be able to look at it because there is proclaims that there's more than one way to skin a cat, right? And for the longest time, I think even the brightest people, all these real estate investment methods, when we follow diligently and act upon, really provides results. So for me, what I would do is you look at it from the perspective of what is your end game, right? What is your goal? Whether you want to create passive income or you want to be a full-time investor. Relative to over leveraging and being able to have enough capital for reserves, I use the about $3,000 to $5,000 per property is what I use as my kind of my end game or my dollar amount that I look at, because at any given time you're going to have vacancy. At any given time you could have any maintenance issues, right? So from an over leverage perspective, always have enough in your account to cover the number of properties multiplied by the number that you have reserved for your potential reserves, and then you should be fine moving forward. Hopefully that answers your question.
Yeah. Let me just clarify a little bit. When you're talking about over leveraging, you're also really kind of tying in the reserves conversation right there. Okay. So I'll kind of separate it just to make it maybe a little bit more clear on the over leveraging thing, at least from our perspective, right? Most people think of over leveraging like how much do I have down or how much do I have compared to what the value of that asset is, and I think a good thing to look at is how are banks lending? Banks are really conservative, and a bank will lend 80% of the value of the property. We have come to understand that you put 20% down. That means that the bank is lending 80%. So if you're buying an asset and you're borrowing 80%, you're following the bank's business model. That's really conservative. That's really good. Like that is not over leverage if you're borrowing 80%. If you start to get to 85, 90, 95, 100, that's where things go haywire, circa, Great Recession, and there you go. So that would be just an easy thing for you. If you're at, call it 75, 80%, you're golden. That's how the lending model works. And then I'm with you on the reserves as well. It's funny that you mentioned $3,000 to $5,000 for a reserve account. I think of this in terms of like, how should one account for rainy days within their own personal finances? Emergency fund, right? Generally speaking, you're thinking you want to have 3 to 6 months of emergency fund set aside, rainy day fund in case you lose your job or something happens or whatever, that you're good. And so you look at what your expenses are and you just multiply that times 3 or 6, depending on your risk profile. And then you're good. You have that set aside and you do that before you start to invest, right? So that same mentality is the same thing you would look at for a rental property. If you've got a rental property and the costs on it are $1,000 a month, then you should have between $3,000 to $6,000 set aside for a rainy day for that rental property. Even though it pays for itself every single month, just like even though you can pay your bills every single month, you still want 3 to 6 months of your personal expenses set aside for that rental property. Think of it the same way. You still want 3 to 6 months set aside. And then the thing about that though is some folks, and then from this point you can kind of go how risk averse you want to go or not. But I don't think you have to multiply that times 10 properties or 15 properties or 20 properties, right? As you start to get to 3 properties, you're going to have a portfolio that can handle the ups and downs largely within the rental income that you're earning. And so as you get to that level, you don't really need to have $15,000 set aside because each month you're going to have, 2, 3, 5, 10 of those properties that are going to be performing well. And you might have a couple that are not going to be performing well, and it smooths it out. So I would really focus on 3 to 6 months of a rainy day fund as you get from 1 to 3 properties, and then you're probably good after that.
All right. Awesome stuff, Gerard. That was answered your question proactively as well. And now we're going to go to the Zach Correa. This is your investment live.
I was giving Zach a hard time because I love everything about Zach. And then I was sitting down. I usually do these portfolio reviews and put the numbers together for our clients. Usually I start on Monday, and I started with Zach on Monday. And wouldn't you know that Zach owns 22 JWB properties? And I was giving him a hard time because this is the most time that I've had to spend, because I actually review and do a market analysis on every property that a client owns here to make sure that I'm giving an accurate return on investment for all 5 profit centers. So Zach, I was just giving you a hard time, man. It's so many properties that you've invested with us, man. I mean, you just, increasing my time of preparation here. I can't believe you did that to me.
Well, I want to make sure I cut into your couch time. So.
Very true. Very true. I mean, my bachelor or bachelorette time that I was using, it's totally just zapped right there. So Zach, and your wonderful wife, Beth, I mean, it is incredible to have you as clients, your trust. I didn't verify this before, but I think you may own the most properties of any client of JWB. If it's not the most, it's right. It's very close. You're up to 22 properties. What an amazing experience for you to share your thoughts, because you've lived this. And it's not that you have just lived in this theory. You've taken the market dynamics over the last 3 years and you've used everything that we talk about to take advantage of the market and the market signals. You started with the team. You bought into the team and the market and all that good stuff. Properties have been easy for you to choose because you knocked out the team and the market. And you look beyond what's going on just in real estate. And you said, how can I pull money from a different asset class to put it here? Because right now, this is a really good time for that. So look at your properties here. We've got 22 properties. The first slide is the ones that I wanted to point out. Those first 1, 2, 3, 4, 5, 6 properties, 7 properties, you bought right off the bat in 2019, okay? It takes a lot of trust for you to invest in 7 properties the first time with a new provider, and you live in Washington. Talk to me about why that made sense for you to invest in 7 right off the bat.
Well, as I mentioned, right, the property is secondary for us, right? It was about the team. So trusting the team, understanding JWB's perspective and their model really provided us, I talk about the fact that the one thing I would describe JWB is trustworthy, right? And I think if you, like anything else, I mean, I'm not going to be here to say that I'm an expert investor at all, even today, 3 years later. I still learn every day about what to do and how to do it. But one thing I learned is that when I was in the stock market, the traditional investing, I was not making this type of returns on investments. So it was easy for me to make the leap. And sometimes I think a lot of folks are afraid to make the leap. A lot of the investors that I talked to, they were afraid to make the leap. And for us, it was about getting to that end game, right? The end time I talked about is a desired cash flow, what we looked at. And the first thing we did, and I heard Pablo talk about this yesterday in his podcast, was that we wanted to maximize our conventional loan opportunities with Fannie Mae, right? We've had some other properties. So I had, in my world, both of us still had around 7 or 8 opportunities, mortgage available. So we immediately cashed out on stock funds, stock options, some of our stocks as well, and we invested right away. And obviously, you see, we invested immediately into new construction because it's the eye candy at the time, right? No other property management company out there that we talked to offered this type of portfolio. And so we jumped in, right? It's no different than if you were offered Tesla or Amazon at the onset. I was on the onset of Boeing when it was $10 a share, for example, when I first worked for them.
Right.
And so you get on, and it's because you believe in the structure and the business model of the company and the team. And it's easy to buy into this. And so buying 7, it was not about how many, it was about who I was buying it from that was more important, and how they would help me manage this going forward. Because passive incomes mean that I rarely want to be involved, but I still want to be the decision maker, right?
It's amazing, right? You've totally flipped this perspective of like, once I nail down the team and I've got a pile of money that's not performing the way that I want, it doesn't matter if it's 3 properties or 5 properties, or 7 properties or 10 properties, whatever that pile of money that's not performing. Now that I know the team that I want to be with, I'm just going to move that pile of money over and I'm going to make sure it's performing the way that I want. And that just happened to be 7 properties for you, right? That's as simple as it is, right?
Yep. I mean, I talked about timing, and capital. We had the capital. It was a perfect timing that these were available. And it was in the time in our lives that we were shifting into a new venture away from alpacas and horses and now into real estate. What a perfect opportunity. Not often do we have an opportunity in life to have something like this happen, right? And you have to capitalize on these type of moments. And if you don't, then you look back and you have regrets, right? And so far I have had no regrets in real estate investing.
Amazing. And let's correlate that to what's going on right now in the stock market, right? the signals are very clear that there is going to be more pain in the stock market. Those signals weren't the same signals that Zach saw in 2019. He was just not happy with how that had performed. Right now, it is like blaring red light, like problem in the stock market, Fed raising the interest rate, right? You know, companies are going to be earning less money. Stock prices are inflated right now, probably coming down. And this can be that opportunity for you to take that pile of money, find an operator that you trust, and then just simply get that pile of money working better. And maybe that turns into 3 properties, 5 properties, 1 property, or 10. Don't get so hung up on the number of properties. Get your pile of money working with somebody you can trust. That's been Zach's approach. And
yeah, I mentioned that earlier, right? Inflation is becoming more influential in financial strategies. And those who believe, like I do, in increasing inflationary environments, hard assets, and leveraging cheaper future monies to pay down the loans is a great strategy.
Absolutely. Well, that's awesome. So there's just half of Zach's portfolio. This is the other half. If you counted all that up, that's 22 properties. And most of them were purchased with financing. He bought some with cash, which is really cool. All right, let's go a little bit more granular. I always want to show folks the good, the bad, the ugly. So we're going to start with the good. This is the highest lifetime return on investment here, this property on Hare Avenue. And yeah, Pablo, look at that, 2020, negative 210%. What the heck's going on there? I'll just give you a spoiler alert. He only owned it for 2 days in 2020 . So when you do that.
If you remember this, JC, that was the last time I was on your show. We had just closed.
Oh yeah.
That's right.
For 2020.
There you go.
Like we closed on 2. We bought 2 Hare properties back to back.
There you go. Well, don't let that scare you. That for those who are watching this, negative 210% is more of just how returns work when you only have 2 days and you have some bill that came in or whatever. You can see annualized lifetime returns at 16.98%, and that does not include home price appreciation. We're going to take a look at what that number really is when you include that in just a second. So there's the shining star, and then we're going to look at the one that hasn't gone so well. All right. This is the one at 734 St. Clair Avenue. We have 3 years there with negative returns, Zach. We have an annualized lifetime return on investment, again, not including home price appreciation, of negative 3.33%. Can you shed some light on this property, your thoughts, and what happened here?
So if you look at my portfolio, this is the only rental property we have in our entire 22 properties, right? That's one thing. I'm not saying it's good or bad. The other thing is this is the only property that we purchased using non-recourse. It's the only one in our whole entire 22 portfolio that we used non-recourse. So we paid, put 50% down, and we're paying, 7.5 or 8% interest on a non-recourse loan, right? But guess what? What we did was we went ahead and refinanced this one, right?
Oh, yeah.
And reduced that. So we are putting some efforts on this, but to your point, because it's the highest interest rate mortgage, that is not what we put as the first property for when you do your C3X, right? Your waterfall approach.
Right.
It is our Fitzgerald properties, right? And the 2 Fitzgerald properties and Jim Johnson properties, those are the ones we paid down. And then the other thing we did in 2021 is that we refinanced these other ones that were 4.75 and move it down to 3.23, so now the IRR is much better, from an improvement perspective. It's just taking advantage of the market. But to your point, Greg, every portfolio has its shining star, and it has its slugs, so to speak, and it's still good. I mean, we had a lot of repairs that had to be done on this rental. We had maintenance repairs that had to be done. And then we had a lot of turn, right? We had people come in and out. So it happens to the best of us.
You own 22 of these things, it's going to happen. The thing I always caution everybody is to not label it so much, because I have seen this over and over and over again, is that the one that is underperforming, call it for the first 3 or 4 years, it has an issue, because that's just how things work when you have 22 of them. It's amazing how that one is the shining star for the next 3 or 4 years, and it all balances out. And guess what? Some of the ones that we love in Zach's portfolio right now are not going to continue to perform at 16.98% like the one on Hare Avenue is. Hate to burst that bubble, but that's the beauty of this thing, because you constantly have this ebb and flow, and these properties tend to balance themselves out. That's why it's so important to diversify as a portfolio there.
And the last
All
thing
right.
you want to do is you don't want to be looking at this all the time. It is an investment, right? For us, we look at it what's the long term, the full market cycle. Talk to me then, right?
Exactly. Well, we're about to take a look at that. I'm glad you asked, my
Let's
friend.
talk about that.
Let's go to the next slide here, because what I'm showing everybody here, and Zach for the first time, is a full picture of your 5 profit centers here. We're looking beyond just cash flow and tax savings and principal pay down. And we're taking a look at the big picture, including home price appreciation. We're also going to talk a little bit about inflation hedging. And I'm going to read some of these numbers out for you that are just staggering. And if you're wondering why, even though this hasn't been perfect for Zach and he has a property that has earned a negative return on investment, if you're wondering why he's all smiles and has said so many just wonderful things today, it's because this big picture is what he pays attention to, right? Since 2019, Zach, you've earned $210,000 in net rental income. You have earned $19,344 in tax savings. That's money that you didn't have to spend, even though you earned all of this wonderful income because of the tax advantages in rental properties. You have paid down, no, let me say that over again. Your residents have paid down $83,000 in principal. That's like literally somebody else that you don't know paying your loan off for you. Wouldn't we all love more people like that?
Oh, yeah.
Well, they're called residents. That's what they're called. That's why, one reason why we love them so much. And then here is the big thing that not enough investors understand how to prepare for and analyze. And it's the biggest percentage of their overall return. It is none other than home price appreciation. Zach, $1,244,000 in home price appreciation for your portfolio of 22 properties, brother. Congratulations.
Yeah, I can't ask for anything better, right? I can't ask for anything better. I mean, I didn't know about this. So for those of you who are on the show, I mean, all my partners in crime on the chat there, this is surprising to me because I don't look at this, right? Because it's not time for me to look at this, but I've never seen it presented to me this way. So I'm glad that you took all the time since Monday, GC, to put this all together. well worth it. I think if we do come down to the meetup, I think you owe me a drink down there.
I think so. Or maybe you owe me a drink. I don't know. We'll owe each other drinks.
There you go. This is awesome. I mean, who would think that we started exactly 3 years ago and to be at this point? This is the vision that you got to believe in. When GC talks about all of this thing, Greg, when you talk about this, here's the proof. When you talk about validation and actual data, the performer will tell you one thing, right? When you purchase it, I looked at performance in 2019, but this is not what I expected, right? This is better than what I expected relative to actual returns. So actual data is what validates how truly successful JWB can be for their clients. So thank you guys. Greg and you and your team, again, I couldn't have done this without you guys. So
well, it all starts with trust, and it's hard to give your trust to another provider, especially, we didn't have a substantial relationship before this. It wasn't like we were friends or neighbors or whatnot. You put your trust and your faith in our team, and we love it. So yeah, man. So, putting all of this in perspective for those who are on the podcast who can't see what's going on here, when you take all of these profit centers and you look at what Zach asked us to perform at as a portfolio for all 22 of his properties, he expected a 6.5% return on investment on his money. Because of our vertically integrated approach and being here in a growth market like Jacksonville and our property management services, we've returned 22.7% per year for Zach's money. That's Zach's money working overtime for him and doing so many great things for him and for his family.
Better take a picture of this and tell Beth so she believes.
Yeah, absolutely. Well, is she going to come down next Friday too? Because we can all take a look at it.
If we come down, both of us will be here, of course.
Love it. I hope so. I'm definitely buying her a drink. You might have to buy me a drink. I'm going to buy her a drink. Oh, brother, this is awesome. Well, here's the last thing. I want people to understand that cash flow is important, but it is one of 5 profit centers. Here, if you break down the total returns for Zach, and I'm going to start to do this for all of our clients, you're going to see how this works. The biggest percent of your total returns is not rental income. The biggest percent of your total returns when you invest for a full market cycle is home price appreciation. 78% of Zach's performance has come from home price appreciation. And here's the kicker. Even if home prices hadn't appreciated the way they have in the last 2 years, this would still be the largest part of the pie for Zach. And that's why you have to choose the right operator and the right market and be like Zach.
Man, that's impressive to see. I want to go back there and look at those numbers and just like look at how much money turned into like $1.2 million.
Yeah.
You know, like that's a really, really impressive thing to just showcase, right? Like you see the commercials of that old number of like, what's your number that's chasing you? And then seeing somebody like seeing Zach's reaction get presented of just like, man, that really just happened. Insane.
Yep.
You know, like really, really cool, man. Thanks for putting that together, GC. Sorry you had to work overtime calculating 22 different.
That's what I love to do. I feel bad. It's supposed to be a joke, but you know, listen, anybody who wants to be like Zach and to put more time on me preparing their portfolio review, that's why I'm here. I love doing it.
Love it, man. And Zach, I'm gonna open up some space in a second for you to take us away because you're always so well prepared and so well spoken. I would be shocked if you don't have a way to stick this landing, but I want to thank our community for being here. You know, we had 35, 40 folks in here, middle of a Thursday, taking time of your day. It never goes unnoticed, unappreciated. I love the magic that happens in the chat. If you're listening on the podcast, you're watching on YouTube, we love to spend time in your ear and you know, be with you, but you're missing out on like the magic in the chat and people making friends and these connections that happen is really special. So go to nyais.com, join us on a Tuesday or Thursday. And Zach, just on a personal level, man, we were just talking about this before the show. Having you in my life as an example of what intelligent strategy around where you want to get to in life and reverse engineering it and the way that you think of things and the way that you explain it has been a major eye opener for me. And my buddy talks about it as like cognitive bias, man. Like when you see it, you can really, really believe it. And seeing what you have accomplished and knowing that you're a real dude and being able to like talk to you and things of the sort has really improved my life for the better. And I'm just so happy to see all your success and how well-deserved it is. And from a couldn't be a better dude. So I'm just going to kick it over to GC and say thank you, man.
I'd echo that. And Zach is like the epitome that like, you know, I believe that nice guys can win. I believe that like nice guys and nice women and people who care about others, I believe they win. And that's what I think of when I look at Zach, right? Yeah. He's winning and he does it in such a humble, just gracious, just friend approach. And our relationship's very special. And I appreciate the journey we've been on. And I know we're going to be on it for many, many, many years in the future. And I'm excited, buddy. Thank you.
You're very welcome. You know, it's been a journey that's been acceptable. And for me, I think the end game is just having a good time and building a relationship and networking. You know, you talked about networking yesterday. Networking is huge. And I think that I see two good friends now, right, that we can talk to and chat at any time. And that we can look at each other and be able to depend on each other when we need to in times of decision making, in times of forks in the road. We talked about that as well. But I think to end today, as you said, Pablo, I do have some things there's 5 things I want to tell people that's on the call today, is 5 lessons from me. Number 1 is, I said this before, invest in yourself, right? The more you learn, the more you earn. Second thing is case, copy and steal everything. Separation really is in the preparation. The third thing is success breeds success. Successful people surround themselves with successful people, right? Number 4, execute, execute, execute. Just do it. Avoid analysis paralysis. And then if you do all 4 of those things, I promise you, as you saw with my portfolio today, beer in the hand with toes in the sand will happen. So I'm hoping to do that next week in Jacksonville with you too. I appreciate everything. Auiho, mahalo nui loa to everyone. And hopefully I'll talk to you guys all soon.
Amazing, man. All right. We'll see you next Tuesday where we're rolling out a new content format. We're showing up with topical things to talk about. Laura, we're adding your question to the mix. Is it better to hold on to a rental or cash out the equity in one rental, buy 2 rentals? It's going to be Greg and I talking about what's going on in the market, what we're seeing, and giving you perspectives on specific things. It's going to be a new format we're going to do every other week. I think you're really, really going to like it. And until then, if you want to have a beer in your hand and toes in the sand, if you want to achieve extraordinary things, you just can't be average. Don't be average. Be like Zach. I'll see you on Tuesday.
See you guys later.
Aloha.